Welcome to our podcast we're calling Navigating the Future: Smart Investments for Uncertain Times. In this video, we're exploring what investment areas might be worth your consideration between now and 2028 or 2030. My name is Steve, and I'm an AI-created avatar for the real Steven, who has guided and written the core of this material. We'll start by conducting an evaluation of the investment environment based on human input and human direction. So take it for what it's worth. And yes, we think that a combination of human and AI research can add value to your thinking on this topic. So let us address the question on everyone's mind. How do we achieve growth while managing risk? Let's look at the macroeconomic context. Let's begin by framing our discussion within today's economic environment. We find ourselves in a period of cautious optimism. Interest rates, which reached concerning heights in 2023, are now stabilizing and may gradually decline as global inflation continues to cool. The United States economy has demonstrated remarkable resilience and is projected to outperform other regions despite ongoing geopolitical challenges. These geopolitical realignments, particularly the reshoring of supply chains, are creating both obstacles and opportunities for investors. For those managing substantial portfolios, this environment requires identifying segments with robust growth drivers, paired with relatively modest risk profiles. Next, let's define low risk, high growth. Before I outline specific recommendations, let me clarify what we mean by low risk, high growth investments. These are sectors or strategies supported by strong secular tailwinds that ensure earnings expansion over the next 3 to 5 years, while exhibiting historically moderate volatility or defensive characteristics. We evaluate these opportunities using metrics such as 5-year compound annual growth rate (CAGR), beta coefficients for volatility measurement, and Sharpe ratios to assess risk-adjusted performance. Ideally, we seek investments with a beta below 1.0, indicating lower volatility than the broader market, combined with an impressive CAGR and favorable Sharpe ratio. Current valuations, particularly forward price to earnings ratios, are equally important to ensure we're not overpaying for anticipated growth. Today, I'll present 5 investment segments that fit this profile, ranked from most promising downward with data-driven insights for each. Let me present the top 5 investment segments for 2025 to 2028, based on the research we've done as of May 7th, 2025. Our first segment is artificial intelligence and big tech. The AI revolution is accelerating at an unprecedented pace, generating productivity improvements across multiple sectors, including healthcare, finance, and logistics. Major technology companies, from cloud computing providers to semiconductor manufacturers, stand at the forefront of this transformation. The AI sector is projected to expand from approximately $300 billion in 2025 to $1.77 trillion by 2032, represent a compound annual growth rate of nearly 29%. Yes, we said trillion. This extraordinary growth trajectory suggests that tech giants enabling AI through software platforms, chips, or services can continue delivering robust revenue and earnings increases. From a macroeconomic perspective, technology and AI-focused firms will benefit as interest rates normalize. Lower rates increase the present value of future earnings, a favorable condition for high-growth tech stocks. Additionally, U.S. policy continues to support innovation through R&D incentives, while corporate investment in AI remains a priority despite geopolitical tensions. The information technology sector has consistently led markets, with the S&P 500 Tech Index returning approximately 21.8% annually over the past 5 years, significantly outperforming the broader market. While tech stocks can exhibit volatility, large-cap technology companies now represent cash-rich, diversified businesses. The sector's 5-year beta of approximately 1.23 indicates slightly higher volatility than the market, but many individual mega-cap tech names demonstrate lower betas due to their operational stability. Current valuations for leading tech companies are elevated, but not extreme. The sector's forward PE ratio of around 25.8 reflects high growth expectations supported by strong earnings prospects. A prudent approach involves gaining broad exposure to the AI/tech theme through ETFs or a carefully selected basket of quality big tech stocks. These firms pair innovation with scale, offering an attractive blend of high growth potential and financial strength. Expected annual returns in this space could reach the low teens, assuming earnings continue rising at approximately 15% and valuations remain stable. Which companies will thrive is a fair question, but that this sector is set for growth is as close to a guarantee as there can be. And of course, as prudent and experienced investors, we understand there are no guarantees. Our second area of focus is healthcare technology and biopharma. The healthcare sector offers a rare combination of defensive characteristics and innovation potential. An aging global population ensures steadily increasing demand for medical services and pharmaceuticals, while breakthrough therapies and health technologies create new growth frontiers. Recent innovations in obesity treatments represent disruption on a scale matched by few other medical advances, with clinical trials showing reductions in diabetes risk by 73% and heart related deaths by 20%. Other developments, from AI assisted drug discovery to targeted cancer therapies, promise significant market expansion for companies in biotech, medical devices, and healthcare IT. Healthcare is traditionally considered a defensive sector, as essential health products and services remain in demand regardless of economic conditions. This baseline stability contributes to lower risk profiles. Notably, healthcare stocks underperformed in 2024, with the sector gaining only about 2% compared to 16% for the S&P 500, leaving valuations at attractive levels. The sector's forward PE ratio stands at approximately 16.8 compared to 20 for the broader market, near decade lows. This suggests many high-quality healthcare companies are reasonably priced today, offering a margin of safety and potential for multiple expansion when sentiment improves. The S&P 500 Healthcare Index delivered approximately 12.2% annual returns over the past 5 years. While this falls short of technology's performance, it remains impressive and comes with substantially less volatility. The index's 5-year beta of just 0.62 indicates significantly lower volatility than the broader market. Healthcare presents an appealing risk-reward proposition, combining a foundation of stability, often with healthy dividends and non-cyclical demand, plus catalysts for above-market growth through new drugs, devices, and healthcare digitization. This segment is positioned for high single-digit to low double-digit annual returns with below-market risk levels.
Before we continue, we have two quick asides. First, please like and subscribe. We'd really appreciate it. Second, in the description below is a list for reference only of exchange-traded funds, ETFs, 3 for each of the 5 areas we're discussing as a beginning place for your research. Thanks.
Let's move on to area number 3, cybersecurity and digital protection leaders. In our increasingly digital world, cybersecurity has become essential spending for businesses and governments alike. Cyber threats continue growing in both frequency and sophistication, compelling organizations to continuously increase security budgets. Global cybercrime damage is projected to reach $10.5 trillion annually by 2025, underscoring the massive scale of this threat. In response, worldwide security spending is expected to increase by approximately 12% in 2025 and maintain double-digit growth in subsequent years. The cybersecurity industry is forecast to grow about 12.4% annually from 2024 through 2027, outpacing broader IT spending. This growth is driven by escalating demand for cloud security, endpoint protection for remote work, and securing critical infrastructure. Companies in this sector enjoy strong tailwinds as cybersecurity has become a must-have rather than a discretionary expense. A recent survey revealed that 79% of organizations plan to increase cybersecurity spending in 2025 despite other budget constraints, testament to the mission-critical nature of this field. Cybersecurity stocks fall under the technology umbrella, but often exhibit more moderate valuations and greater stability than speculative tech startups. Their revenues frequently recur through subscription models and remain relatively insulated from consumer sentiment or economic cycles. The sector's volatility has been reasonable, with the Prime Cybersecurity ETF delivering approximately 11% annual returns over the past decade, with standard deviation comparable to the broader market. Another leading fund, the First Trust CIBR ETF, has a 5-year beta of roughly zero point 0.9, indicating slightly lower volatility than the market. Over the next 3 years, this segment could reasonably achieve low double-digit annual returns, fueled by 10 to 15% revenue growth and improving profitability across many cybersecurity firms. The ongoing necessity of cyber defenses provides a floor for these stocks, even during economic downturns. Let's look at area number 4, advanced manufacturing and robotics. Advances in robotics and automation are transforming manufacturing, logistics, and even service industries. Industrial robots are becoming simultaneously more intelligent and more affordable, driving adoption across sectors from automotive to electronics. The global industrial robotics market is projected to grow from approximately $87 billion in 2024 to $163 billion by 2030, representing an 11% compound annual growth rate. Beyond factory robots, this theme encompasses automation software, advanced machinery, and companies enabling next-generation manufacturing technologies. A key macroeconomic driver here is the push for supply chain resilience. After recent disruptions, many companies and governments are investing heavily in domestic production capacity. New manufacturing construction in the United States has surged, with a significant portion of that capital directed toward automation equipment. The advanced manufacturing sector bridges technology and industrials, creating a mixed risk profile. Many companies in this space have tangible products and established customer bases, lending greater stability than purely speculative ventures. Traditional industrial giants involved in automation often demonstrate moderate betas around 1.0 and provide solid dividends. However, portions of this segment can exhibit cyclicality. During sharp economic slowdowns, businesses might delay capital expenditures on new equipment. The beta for pure-play robotics ETFs is approximately 1.4, reflecting historically higher volatility. We expect mid to high single-digit earnings growth for many industrial technology companies, with additional upside if automation adoption accelerates. Combined with dividends where applicable, this suggests potential annual returns around 10%. That's a formal projection. My seat of the pants guess would be that robotics will, at some point, experience the kind of explosive growth that we have seen in the past with smartphones. It's hard to grasp that at one point, about 20 years ago, there were no iPhones. Period. Now they are everywhere. I expect a similar or faster adoption curve with robotics. Our fifth business segment is clean energy and energy storage. The clean energy sector, which currently encompasses renewable power generation, battery storage, and related technologies, is positioned for rapid growth, supported by powerful secular and policy forces. In 2024, renewables accounted for over 90% of new power capacity additions worldwide, an unprecedented share. Global investment in green energy has reached record levels as countries strive to meet climate targets. According to market forecasts, the renewable energy industry is expected to grow approximately 17% annually through 2034, potentially expanding from $1.7 trillion in 2025 to over $7 trillion by 2034. With major economies enacting supportive legislation such as the U.S. Inflation Reduction Act and European Green Deal, revenue visibility for many clean energy projects has improved substantially. Companies in this space range from renewable power producers to manufacturers of solar panels, wind turbines, and battery cells to critical materials suppliers. Historically, clean energy has been a volatile segment. It experienced tremendous gains in 2020 to 2021, followed by a steep correction as supply chain issues and rising interest rates impacted solar and wind stocks. This volatility means the 5-year historical CAGR for leading clean energy ETFs remains in the low single digits. However, that past volatility was partly attributable to valuation extremes. Today, many renewable stocks trade at more moderate multiples. Some solar manufacturers near 15 to 20 times earnings, and renewable asset owners often trade at utility like multiples in the teens. We anticipate this segment could deliver high trajectory growth, potentially low teens percentage annual returns, but with higher year to year volatility. The combination of accelerating green adoption and substantial government incentives could make clean energy one of the fastest growing segments over a 3-year horizon. A wildcard in this segment, just to emphasize the point, is the impact of social pressure and government regulation, as well as possible tax policies being very fluid that may distort the economic picture in this area. So let's summarize very briefly the performance metrics and look at some comparisons. Let me briefly summarize the key metrics for each strategy. Area 1, AI and Big Tech. 21.8% 5-year CAGR, beta of 1.2, forward PE around 25.8x, with expected 3-year returns of 12 to 15% annually. Area 2, healthcare technology, 12.2% 5-year CAGR, beta of 0.6, forward PE of 16.8x, with expected 3-year returns of 8 to 10% annually. Area 3, cybersecurity, approximately 11% 5-year CAGR, beta of 0.9, forward PE around 30x, with expected 3-year returns of 10 to 12% annually. Area 4, advanced manufacturing and robotics, 8 to 9% 5-year CAGR, beta of 1.4, forward PE of 21.8x, with expected 3-year returns of 9 to 11% annually. And last on our list of 5 is clean energy, 3 to 4% 5-year CAGR, beta of approximately 1.1, forward PE of 17 to 20 times, with expected 3-year returns of 10 to 15% annually. So let's move on to constructing the optimal portfolio that can take advantage of these trends. Let me reinforce an important point. Some people are adept at finding and investing in just the right companies for the best future prospects. But not everyone has that skill. For those who are seeking more of a set and forget strategy, a look at industry-specific ETFs is probably in order. These exchange-traded funds are managed by professionals who follow the industry in question, and they manage the fund's investments. For clients with substantial portfolios seeking balanced, low-risk, high-growth opportunities, we think you might consider allocating across all 5 segments we've discussed today. But please, please, please look at a diversified strategy that includes other sectors. And please consider the use of a professional investment advisor. This approach harnesses multiple macroeconomic trends while diversifying risks. These segments often demonstrate low correlation. When growth stocks fluctuate, defensive sectors like healthcare may move in the opposite direction. Clean energy's performance doesn't depend on the same factors as cyber security. By combining them strategically, investors can achieve a portfolio with a higher Sharpe ratio, better risk-reward characteristics than any single segment alone. Regular monitoring of macroeconomic indicators and valuations remains essential. If interest rates fall faster than expected, growth sectors like technology and clean energy could outperform projections. If geopolitical events create market turbulence, defensive areas like healthcare might take the lead. Regardless of short-term fluctuations, all highlighted segments are supported by enduring trends that should materialize over the next 3 to 5 years, if not beyond. By focusing on these areas, investors position themselves to seek high growth while preserving capital and limiting downside risk more effectively than generic growth strategies. In closing, there are no guarantees in investing, but a data-driven approach targeting favorable risk-reward niches tilts the odds in your favor. And the 5 strategies I've outlined today represent our roadmap to navigate mid-decade markets with confidence and prudence. Please note that our actual investment strategy involves a more comprehensive diversification, looking at dividend-paying companies as well as the niches we've discussed. Our podcast remains committed to helping you identify and capitalize on these opportunities, balancing growth aspirations with appropriate risk management. I welcome your questions and look forward to discussing how these strategies might be tailored to your specific financial objectives. Thank you for your attention, and if you found value in our discussion, please like and subscribe. Of course, this is not investment advice, just a discussion of the underlying conditions we find ourselves in. Thanks for listening, and we do hope you'll come back.